Imagine waking up tomorrow and your money doesn't work. Not the cash in your wallet, not the numbers in your bank account, nothing. Sounds crazy? Maybe. But money's never been about what it is, it's about what we believe it is. And right now, that belief is shifting fast. Welcome everybody to Coin for Coin, your compass in the world of cryptocurrencies. Today we're diving into the fascinating history of money, from bartering and gold coins to credit cards and digital wallets. How did we get from trading goats to tapping our phones to pay? And more importantly, what's next? Let the journey begin. Chapter 1: Money in Motion, from gold coins to bits and bytes. Welcome to the weird world of money. Money runs the world, and nobody really understands it. Sure, we know how to use it. We earn it, we spend it, we stress about it. But have you ever stopped and asked what money actually is? Is it a thing, a number, a feeling, a social contract, all of the above? Welcome to the strange, ever-shifting world of value, where a wrinkled piece of paper can buy you dinner and a few invisible digits on your phone can move halfway across the globe in seconds. It's easy to take it all for granted until you realize that what we call money has been everything from shells and stones to plastic cards and crypto wallets. In this chapter, we're taking a walk through the history of money, not the boring textbook version, but the real story. Messy, creative, occasionally ridiculous, and always evolving. You'll see how money has transformed again and again, driven by one thing: human frustration. When systems break or feel outdated, people invent something new. So buckle up. Before we dive into crypto, blockchains, and the revolution that's reshaping modern finance, we need to understand where we've been. Because money isn't just about numbers, it's about trust, power, and the choices we make when old rules stop working. This isn't just history. This is the setup for a financial plot twist that's already underway. Let's be honest, money is weird. We all want it, we all use it, and somehow it's both a piece of paper and a number on your phone screen that you trust will still be there tomorrow. Well, hopefully. But here's the thing, money hasn't always been green bills, metal coins, or digital balances in a banking app. The story of money is one long, dramatic makeover. Think of it as the ultimate glow-up, with each era swapping the hairstyle and outfit to match the times. The pre-money days, the awkward stage. Before money, there was bartering. You had a goat, I had some grain, we swapped, and everybody went home happy. Well, sort of. The problem? Not everyone wanted your goat. Try paying rent in goats today. Good luck convincing your landlord. This, I'll trade you this for that system worked for small communities but collapsed the moment trade got bigger. Imagine trying to keep track of exchange rates between goats, fish, pottery, and woven blankets. It was messy, slow, and frankly exhausting. So humans got clever. They started looking for something everyone valued, something that could be used anywhere. Enter commodity money. Shiny rocks and seashells, the first universal currency. Gold, silver, copper, shells, beads. If it was rare, shiny, and hard to fake, people were into it. These were the first currencies, physical stuff you could carry around and trade. Gold in particular had star power. It didn't rust, it looked great as jewelry, and people all over the world agreed it was valuable. This gave rise to gold coins, the first truly global bling. But even gold had its drama. First, it's heavy. Second, it's not exactly convenient when you're trying to buy a loaf of bread. Imagine whipping out a chisel and shaving off a few flakes to pay for lunch. Not ideal. Paper money was the big upgrade. Somewhere along the way, someone said, what if we just carry receipts for gold instead? That's basically what early paper money was. A promise you could exchange the paper for actual gold stored somewhere safe. China was the first to go big with paper currency around the 7th century. Europe caught on later, and by the 17th century, banknotes were becoming a thing. It was lighter, easier, and way less likely to give you back pain from carrying it around. But here's the twist. Over time, those pieces of paper stopped being tied to gold. Governments just said, "Trust us, this paper is worth something." And somehow, we did. That's called fiat money. Currency backed by belief rather than by shiny metal. The emotional side of money. Fast forward to the mid-1900s and suddenly cash isn't cool anymore. Credit cards are. You could swipe a piece of plastic and walk away with groceries, gas, or even a new TV without paying right away. Magic. Well, magic with a catch. That catch was interest rates, which could turn your $50 purchase into a $75 headache if you weren't careful. But plastic money made transactions faster and more convenient, a big step toward the fully digital economy we have today. Digital balances, the money you can't touch. By the time online banking and PayPal rolled around, money had gone almost completely invisible. Your paycheck didn't arrive in cash, it showed up as numbers on a screen. You could send it across the country or the planet in seconds. But that convenience came with a dependency: middlemen. Banks, payment processors, credit card companies, they all sat between you and your money, taking a small cut for their trouble. And that's where the seeds for the next big shift started to grow, because not everyone liked those middlemen. The emotional side of money. Here's the thing, money is never just math. It's trust, it's belief, it's collective imagination. The only reason a $20 bill buys you dinner and a drink is because we all agree it does. When that trust is shaken by inflation, bank failures, or global crises, people start looking for alternatives. And historically, every big leap in the money timeline came from a moment of doubt in the old system. Gold replaced barter because barter was too messy. Paper replaced gold coins because coins were too heavy. Digital payments replaced paper because paper was too slow. So, what happens when people start thinking even banks are too slow, too expensive, or too controlling? That's where our story takes a sharp turn into the 21st century. Picture it, 2008. The world is in financial chaos. Banks are collapsing. People are furious. Out of nowhere, a mysterious figure, or maybe a group, named Satoshi Nakamoto drops a white paper on the internet describing something completely new. A form of money that lives entirely online. No banks, no middlemen, no government control, just a network of people agreeing on the rules. And with that, the first block of Bitcoin was mined. For now, remember this. Money has never been a fixed idea. It's a shapeshifter, adapting to the needs and frustrations of the people using it. And just like gold coins replaced goats and digital apps replaced paper bills, the next transformation is already here. And it's going to change everything you think you know about money. Chapter 2, The Big Bang of the Crypto Era. Why Bitcoin's debut in 2009 sparked a whole new financial world. Picture this, it's 2008. The global economy is doing its best impression of a Jenga tower that just lost 3 key blocks. Banks are failing left and right. Big investment firms, the ones that were supposed to be too big to fail, are collapsing like a bad soufflé. People are losing jobs, homes, and trust in a system that was sold to them as rock solid. If you lived through it, you remember the headlines. If you didn't, imagine a financial apocalypse, but without zombies. People were panicking. Retirement savings vanished overnight. Entire communities were shaken. And perhaps most disturbingly, many of the institutions responsible walked away relatively unscathed, thanks to government bailouts funded by the very taxpayers who had lost the most. A crisis breeds an idea. In the middle of all this chaos, governments were scrambling. Their solution? Print more money, bail out the banks, and hope the system would magically fix itself. Spoiler, this made a lot of people very, very angry. Why? Because ordinary people were losing everything, while the same institutions that helped cause the mess were getting saved with public funds. It felt like the rules were rigged, because in many ways they were. It was in this storm of frustration and distrust that something new appeared. On January 3rd, 2009, a mysterious figure, or group, going by the name Satoshi Nakamoto mined the very first Bitcoin block, known as the Genesis block. Hidden inside its code was a tiny Easter egg, a headline from that day's newspaper. It read, The Times 03 Jan 2009 Chancellor on brink of second bailout for banks. It wasn't just a timestamp, it was a statement. Bitcoin was born as a direct response to a broken system. The idea in a nutshell. Satoshi's vision was simple but also radical. What if we had money that wasn't controlled by any bank, government, or single company? Instead of one central authority keeping the ledger, what if thousands of computers around the world worked together to track every transaction, making the system nearly impossible to cheat? And here's the kicker. What if the total supply of that money was fixed forever, so no one could just print more and dilute its value? That's Bitcoin, a digital currency with no CEO, no headquarters, and no bailout button. No middleman, no permission required. To understand how different this was, you have to compare it to the money we already had. In the traditional system, every transaction flows through middlemen, banks, payment processors, credit card companies. They verify it, approve it, and take a small or not so small fee along the way. Bitcoin removed those middlemen entirely. You could send value directly from one person to another anywhere in the world without asking permission from a bank, without waiting for business hours, and without anyone being able to block or reverse it. In other words, Bitcoin turned the financial system into email. Fast, direct, borderless, and much like email revolutionized communication, Bitcoin laid the groundwork for a revolution in how we think about and move value. The technology that made it work. This wasn't just magic, it was blockchain, a system where every transaction is recorded in a public ledger that's shared across thousands of computers. Once a transaction is confirmed and added to the blockchain, it's permanent. No edits, no oops, my bad, let me change that. This makes cheating incredibly hard because you'd have to convince the entire network to agree to your fake entry. And good luck doing that when thousands of strangers are watching your every move. Bitcoin also introduced mining, the process where powerful computers race to solve complex math puzzles. The winner gets to add the next block of transactions to the chain and earns some Bitcoin as a reward. Mining wasn't just a way to create new Bitcoin, it was the security system. Those math puzzles made it expensive and difficult for anyone to mess with the ledger. Think of it like a vault, but one made of math, not steel. The early days, digital pocket change. In 2009 and 2010, Bitcoin wasn't worth much. In fact, the most famous early Bitcoin purchase was in May 2010, when a programmer named Laszlo Hanyecz paid 10,000 BTC for 2 pizzas. At the time, it was about $41 worth of Bitcoin. Today, let's just say those were probably the most expensive pizzas in history. We're talking hundreds of millions of dollars at peak prices. But back then, Bitcoin was still seen as an experiment, a cool idea, but not something you'd use to pay rent. It was mostly traded between tech enthusiasts, cryptography nerds, and people who just liked the idea of money that wasn't tied to a bank. It was underground, niche, and, let's be honest, kind of weird. The hype begins. By 2011, Bitcoin started gaining attention beyond the tech world. The price climbed from under $1 to over $30 in a matter of months. People began to realize this wasn't just some internet hobby, it was a new kind of asset. Of course, this also attracted some less wholesome attention. Bitcoin became known for being used on the Silk Road, an online black market. The media ran with that narrative, painting it as money for criminals. But here's the truth. Yes, some shady stuff happened. But shady stuff also happens with cash every day, and nobody suggests banning cash. Bitcoin's potential went far beyond that early reputation. Why people started paying attention. Bitcoin offered something people had never seen before. Scarcity. Only 21 million will ever exist. No printing more. Transparency. Every transaction is public on the blockchain. Borderless. Send it anywhere in minutes. Censorship resistance. No one can freeze your account. For people in countries with unstable currencies, Bitcoin wasn't just a curiosity, it was a lifeline. In Venezuela, Argentina, Turkey, and beyond, people saw their national currencies collapse due to hyperinflation. In places where banks were unreliable or where governments restricted access to foreign currencies, Bitcoin provided an escape hatch, a way to store value and move it freely. Even if you didn't fully understand the tech, the appeal was obvious. This was money that no one could take from you. Trust without trusting. One of Bitcoin's biggest innovations was the idea of a trustless system. Now, trustless doesn't mean it's shady. It means you don't have to trust a person or institution to play fair. You trust the math, the code, and the network rules, which everyone can see and verify for themselves. It's like playing a game where the rulebook is public, the scoreboard is public, and every move is recorded so no one can cheat. This was radical in a world where entire economies had been wrecked by trusting the wrong people. The ripple effect. Bitcoin's launch didn't just introduce a new type of money, it opened the floodgates for an entire industry. Developers started thinking, if we can make decentralized money, what else can we decentralize? That question would eventually lead to thousands of other cryptocurrencies, decentralized apps, and even concepts like decentralized organizations. Bitcoin lit the fuse, and the explosion that followed would redefine how we think about ownership, governance, and value itself. But that's jumping ahead, setting up the next chapter. By the early 2010s, Bitcoin had gone from obscure internet experiment to a global conversation. Governments, banks, investors, and everyday people were starting to take notice, some with curiosity, others with fear. The stage was set for the next wave of innovation, a cryptocurrency that would take the same blockchain technology and apply it to far more than just money. A cryptocurrency that could turn code into contracts and contracts into unstoppable programs. That's the story of Ethereum, and it's coming up in Chapter 3. But before we get there, remember this. Bitcoin's Big Bang moment wasn't just about creating digital cash. It was about creating a whole new way to think about trust, value, and freedom in the digital age. And whether you love it, hate it, or still don't quite get it, the world hasn't been the same since. Chapter 3, Crypto Made Simple. What coins, tokens, wallets, and keys really mean. Let's face it, the crypto world can feel like walking into a secret club where everyone's speaking in code. You hear words like HODL, seed phrase, and gas fees, and suddenly you're wondering if you accidentally stumbled into a sci-fi convention instead of a financial conversation. There's talk of wallets that don't hold money, coins that don't jingle, and transactions that cost more than what you're actually sending. Confused? You're not alone. But don't worry. In this chapter, we're going to strip away the jargon, ditch the overcomplicated explanations, and break crypto down into simple, everyday terms. Think of this as the crypto tourist guide. You'll leave knowing where everything is, what it's called, and how not to accidentally order something weird off the menu. Coins versus tokens, the siblings that never quite look alike. Here's the first thing to know. Coins and tokens aren't the same thing, even though people use the words like they're interchangeable. Coins are like the main currency of their own blockchain. Bitcoin is a coin. Ethereum, ETH, is a coin. They're native to their networks, meaning they were born there, they live there, and they don't work without it. Think of them like the official currency of their own digital country. Tokens, on the other hand, are more like apps that run on top of an existing blockchain. Think of them like loyalty points at your favorite coffee shop. They're not the official money of your country, but they still have value in a certain system. So Bitcoin is the official money of the Bitcoin network. Ether is the official money of the Ethereum network. But something like Shiba Inu or USDC, those are tokens living on Ethereum's real estate. Some tokens represent money. Others represent game items, voting rights, or even shares in a project. It's like a digital Lego set. You can build almost anything with the right pieces. Wallets are your digital cash stash. When people hear crypto wallet, they sometimes imagine a little leather pouch that holds virtual coins like a video game inventory. Not quite. A crypto wallet is basically a digital tool, an app, device, or browser extension that lets you send, receive, and interact with crypto. But here's the twist. Your wallet doesn't actually hold your coins. All your crypto lives on the blockchain. Your wallet just holds the keys that prove you own it. Without those keys, your coins are basically locked away forever, floating in blockchain limbo. Some wallets live on your phone. Some live on a USB stick, others live entirely in your browser. But no matter the format, the principle stays the same. Your wallet is your digital keyring. Private keys are the keys to the kingdom. If your crypto wallet is like a house, your private key is the front door key. Lose it and you're locked out permanently. This is where crypto is different and less forgiving than your bank. If you forget your online banking password, you can call customer service, prove you're you, and reset it. In crypto, there's no forgot password button for your private key. If you lose it, there's no hotline to call, no reset link in your email, no friendly bank teller to help you. That's why private keys are sacred. You keep them safe, you never share them, and you treat them like the combination to a vault full of gold. Many wallets now give you a seed phrase, 12 to 24 random words that act as a backup for your private key. If your phone dies or your computer explodes, this phrase can recover your wallet. But lose that too? Game over. Public keys are like your crypto address. Your public key is the one you can share. Think of it like your email address. People need it to send you funds, but it doesn't give them access to your inbox or wallet. Public keys are usually turned into shorter, friendlier versions called addresses, so you're not stuck copying a 64-character string every time. Still, they look like something a cat might type if it walked across your keyboard. Yeah, it's not pretty, but it's yours, and it works. If someone sends crypto to your public address, it's recorded forever on the blockchain, no matter where in the world they are. That's powerful. Blockchain, the public ledger, everyone can see. We touched on this before, but here's the short version. A blockchain is like a public spreadsheet that anyone can view, but no one can erase. Every time you send or receive crypto, it's recorded in this spreadsheet, forever. This is why people say crypto is transparent. It's not anonymous in the sense of being invisible. It's anonymous in the sense that your transactions are tied to your address, not your name. Of course, if someone connects your address to you, now they can see everything you've ever done on that blockchain. So, privacy in crypto is a balancing act. Transparent by design, but private if you stay smart. Exchanges, the supermarkets of crypto. If you're wondering where you actually buy cryptocurrencies, that's exactly what exchanges are for. Centralized exchanges, CEXs, like Coinbase or Binance are like big online banks for crypto. They're user-friendly, beginner-friendly, and offer a simple way to get started. But you're trusting them to hold your funds, which means if they get hacked or go under, you could be out of luck. Decentralized exchanges DEX like Uniswap are peer-to-peer. No middleman, no company holding your funds. The trade happens directly between users through smart contracts, bits of code that execute trades automatically if certain conditions are met. Think of it like shopping at Amazon, CEX, versus trading with people directly at a flea market, DEX. Both work, you just need to know the rules. Gas fees, the price of doing business. On blockchains like Ethereum, you have to pay a small fee for every transaction. This is called a gas fee, and it's basically like tipping the network to process your transaction faster. The busier the network, the higher the tip. Some days gas is cheap. Other days it feels like you're paying $40 just to send $20 worth of crypto. Not ideal. That's why newer blockchains like Solana, Avalanche, or Layer 2 solutions like Arbitrum and Polygon are working on faster, cheaper alternatives. Pro tip, always check the fee before clicking send. It can save you some serious frustration. Volatility, the crypto roller coaster. Here's something you can't ignore. Crypto prices move a lot. You could wake up with your holdings worth $1,000 more than yesterday, so or $1,000 less. This volatility is part of what makes crypto exciting and terrifying. For some people, it's a chance to make life-changing gains. For others, it's a recipe for sleepless nights. That's why the golden rule of crypto still stands: never invest more than you're willing to lose. And don't check the price every 5 minutes, unless you enjoy emotional whiplash. Security, don't be the low-hanging fruit. Crypto isn't unsafe, but carelessness is. Scams, phishing attacks, fake apps, and shady websites, they're all part of the internet jungle. The same way you wouldn't hand a stranger your credit card and PIN, you shouldn't click sketchy links or share your private keys. Use strong passwords, enable two-factor authentication, double-check addresses, and most importantly, keep your seed phrase offline, written down, stored safely, and never uploaded to the cloud. One mistake can cost you everything, so don't be the easy target. The big picture and why it matters. At this point, you might be thinking, okay, I get what it is, but why should I care? Here's the thing. Crypto isn't just about sending money without banks. It's about giving people full control over their assets, opening up financial services to people without access to banks, enabling fast, cheap payments across borders, building systems that run 24/7 without middlemen, creating open, programmable financial tools anyone can use. It's also the foundation for some of the most exciting technologies emerging right now, like DeFi, NFTs, Web3, and even new kinds of companies that run on code instead of CEOs. Crypto isn't just changing how we pay, it's changing how we organize, own, and interact online. Ready for what's coming next? Now that you understand the building blocks, coins, tokens, wallets, keys, we can start talking about the engine that makes all of this possible, the blockchain itself. Because as cool as Bitcoin is, it's the blockchain underneath that's changing the world in ways far beyond just digital money. And in the next chapter, we're going to dive into how that technology works without making your head explode. Promise. Chapter 4, Blockchain, the Invisible Backbone. How a decentralized network creates trust without middlemen. Alright, so by now we've tossed around the word blockchain a few times, kind of like that friend who keeps showing up at parties, but you're not entirely sure what they actually do for a living. Time to clear that up. Wait, what even is a blockchain? At its core, a blockchain is just a database. Yep, that's it. A fancy, overhyped database. But here's the twist. Instead of living on one company's server, it lives on thousands of computers all over the world. Picture a giant spreadsheet, one that lists every single transaction ever made in a particular cryptocurrency. That spreadsheet isn't stored in one place. It's copied and constantly updated on all those computers in the network. Everyone has the same version. Why does that matter? Because if everyone's got the same list, you can't secretly change it without everyone else noticing. It's like trying to cheat in a group project when the entire class is watching over your shoulder. Good luck with that. It's transparency by design, and it's a game changer. The block in blockchain. The name isn't just for show. Transactions are grouped together into chunks called blocks. Each block has a bunch of transaction data, who sent what to whom, a timestamp, a special cryptographic fingerprint called a hash. Once a block is full, it's locked in place and linked to the one before it. Over time, you get a long, unbroken chain of blocks, hence blockchain. This chain is permanent. You can't go back and change something in an old block without also changing every single block that came after it. And pulling that off is, let's just say, it's about as easy as trying to reassemble an egg you dropped on the kitchen floor. Even if someone tried to fake a transaction, the system would instantly detect the inconsistency because everyone else's version wouldn't match. It's security by majority consensus. Why everyone says it's trustless. When you hear people call blockchain a trustless system, they don't mean it's shady or unreliable. They mean it doesn't require you to trust any single person or organization. With traditional banking, you're trusting your bank to update its ledger correctly and honestly. With blockchain, you're trusting math, cryptography, and the network itself. Thousands of independent computers are all cross-checking each other in real time. It's like having the world's most nitpicky accountant hovering over every transaction, yelling nope the moment something looks off. You don't need a middleman, a notary, or an authority. You need code, and code doesn't lie. How new blocks are added. This is where it gets interesting, and a little competitive. Adding new blocks isn't just typing some data into a spreadsheet. The network needs to agree on what's true before anything is added. That process is called consensus, and different blockchains have different ways of reaching it. Proof of work, POW, Bitcoin uses something called proof of work, a system where miners, computers, not guys with pickaxes, race to solve ridiculously hard math puzzles. First one to solve it gets to add the block and earns some new Bitcoin as a reward. This process takes energy and computing power, but it also makes the system secure. Cheating would require you to outcompute the rest of the network, which is basically impossible unless you own half the world's supercomputers. Proof of stake, POS. Ethereum used to use POW too, but it has since moved to proof of stake, which is way more energy efficient. In this system, validators lock up some of their crypto, their stake, as collateral. If they behave honestly, they get rewarded. If they try to cheat, they lose their stake. Think of it like poker. Everyone's got skin in the game, and no one wants to lose their chips. Other blockchains use different models, like delegated proof of stake, proof of history, or even newer experiments. But they all aim to answer the same question. How do we agree on what's real without a boss in charge? Why not just use a normal database? That's a fair question. After all, traditional databases are faster, simpler, and don't require nearly as much electricity. But they have one big weakness: centralization. If one company controls the database, they can edit or delete data, freeze accounts, reverse transactions, or shut down whenever they want. Blockchain avoids this by spreading control across a network. No single person or entity can change the records without everyone else agreeing. That makes it resilient, transparent, and hard to corrupt. It's slower and messier, but it's also more democratic. Beyond money, other uses of blockchain. Here's where things get really interesting. Blockchain isn't just about Bitcoin or digital money. Because it's a secure, unchangeable, public database, it can be used for all kinds of things. Supply chains. Track goods from farm to factory to store, with proof at every step. Digital identity. Imagine owning your online ID instead of logging in with Facebook or Google. Voting systems. Secure, transparent elections where every vote is traceable and verifiable. Healthcare records. Shareable medical data that's accurate, private, and tamper-proof. And NFTs. Love them or hate them, they're proof of ownership for digital art, game items, tickets, and more. Basically, anywhere you need verifiable truth, blockchain could help. Of course, not all these ideas are perfect, some are just getting started, others are still theoretical, but the potential is massive. The transparency paradox, one of blockchain's biggest strengths, is also its biggest quirk. It's incredibly transparent. Anyone can look up any transaction ever made on a public blockchain. You can see wallet balances, transaction histories, and activity going back years. But here's the twist, that while transactions are public, names aren't attached. Everything is tied to addresses, not people. That's why it's called pseudo-anonymous. If no one knows which wallet belongs to you, you're private. But if someone connects your identity to that wallet address, they see everything. Every send, every receive, every pizza bought with crypto. It's a trade-off. Transparency builds trust, but it can also expose your entire financial life if you're not careful. The energy debate. Let's talk about the elephant in the server room, energy consumption. Blockchains like Bitcoin, which use proof of work, consume a lot of electricity. Critics argue it's wasteful, especially when we're trying to combat climate change. Supporters push back saying, most of the energy is renewable. The system is more transparent than most industries. Traditional banking and gold mining also use massive amounts of energy. Energy usage is what makes the system secure. It's a heated debate, pun 100% intended, and it's driving innovation. More and more projects are moving toward greener solutions like proof of stake or carbon-neutral networks. Bottom line, the blockchain world is trying to clean up after itself, but the conversation isn't over. Why blockchain feels so revolutionary? Here's the big picture. Blockchain flips the power structure. Instead of one central authority controlling the records, you've got a global community keeping each other honest. Instead of needing to ask permission, you just participate. Send money? Done. Create a smart contract? Done. Join a decentralized organization? Done. All without signing forms, standing in line, or proving your worth to a gatekeeper. That's why blockchain is often compared to the early days of the internet. Back then, nobody fully understood it either. It started with geeks in basements and turned into the backbone of modern life. Now, blockchain is having the same moment, and we're just getting started. And remember, blockchain isn't about eliminating trust, it's about removing the need for it. You don't have to trust a person, you trust the system. You don't rely on someone being honest, you rely on the fact that cheating just doesn't work. That's a big shift, and it's one that's already rewriting the rules of money, data, identity, and maybe someday, democracy itself. Chapter 5, Bitcoin more than just digital gold. Its philosophy, technology, and global impact. If you've heard of just one cryptocurrency, it's probably Bitcoin. Even people who have no idea what a blockchain is have at least a vague sense that Bitcoin exists, kind of like knowing Paris is in France without being able to find it on a map. It's been called digital gold, magic internet money, the biggest scam ever, and the most important invention since the internet. Depending on who you ask, it's either going to save the financial world or burn it to the ground. Let's unpack what makes Bitcoin so fascinating, and why, after more than a decade, it's still the heavyweight champion of the crypto arena, born from a crisis. We've talked about how Bitcoin appeared in the middle of the 2008 financial meltdown, but the timing wasn't just coincidence, it was the point. Banks had shown they could take enormous risks with other people's money, and when it all went wrong, governments bailed them out by printing even more money. Trust in the system was at an all-time low. Bitcoin's creator, or creators, hiding behind the name Satoshi Nakamoto, saw this as a chance to try something radical, a form of money that didn't require trust in banks, governments, or any single authority. It was a protest in the form of code, a blueprint for financial independence, built not on hope, but on hard math. Digital gold, but with superpowers. The digital gold nickname isn't just a marketing slogan. Bitcoin shares a lot with gold. Limited supply. There will only ever be 21 million Bitcoins. That's it. No central bank can decide to make more. Hard to counterfeit. You can't fake a Bitcoin any more than you can fake a gold bar, at least not successfully for long. Store of value. Many people hold Bitcoin as a hedge against inflation and currency devaluation, especially in times of uncertainty. But Bitcoin takes it further. You can send it across the world in minutes. You can divide it into tiny fractions, down to 100 millionth of a Bitcoin, called a Satoshi. And unlike gold, you don't need a vault, armed guards, or an armored truck to move it. Bitcoin is programmable, weightless, borderless, and that makes it not just Gold 2.0, but something entirely new. How it actually works, without making your head hurt. Bitcoin runs on a blockchain, which we've already covered. The part that matters here is how new transactions are added to that blockchain. It all comes down to a network of miners, computers that compete to solve cryptographic puzzles. When one solves the puzzle, they get to add a new block of transactions and earn some newly created Bitcoin as a reward. This process, called proof of work, is like a giant global competition. It keeps the system secure by making it expensive to cheat and profitable to play by the rules. Yes, it uses energy, but that energy is what keeps the network honest and decentralized. Why people trust it? Here's the paradox. Bitcoin is trustless, yet people trust it. It's transparent. Every transaction is publicly visible on the blockchain. It's predictable. New Bitcoins are released on a fixed schedule until the maximum supply is reached. It's decentralized. No single entity controls it, and no one can change the rules without global consensus. Compare that to the traditional system, where central banks can print more money at will or freeze your account overnight. Bitcoin's rules are written in code, and code doesn't play favorites. The HODL mentality. If you've ever been on a crypto forum, you've seen the word HODL. It started as a typo for hold in a drunk forum post back in 2013, but it stuck. Now it's crypto slang for hold on for dear life. This isn't just internet humor. It's a core philosophy. Bitcoiners believe in the long game. They ignore the dips, tune out the panic, and focus on the big picture. It's part investing strategy, part personal identity. For many, Bitcoin isn't just money, it's a movement. Bitcoin as a lifeline. While some treat Bitcoin like digital stock, for others it's a lifeline. In countries where inflation spirals out of control, think Venezuela or Zimbabwe, Bitcoin offers something the local currency doesn't: stability. In nations with strict capital controls or frozen banking systems, Bitcoin allows people to move money across borders without asking for permission. And in places with limited financial infrastructure, Bitcoin opens access to global finance with nothing more than a smartphone. Is it perfect? No. Internet access is still a barrier, and price volatility makes it risky. But in many cases, Bitcoin is the least bad option, and sometimes the only one. Criticism and controversy. Bitcoin has its fair share of critics. They point to volatility. Prices can swing 10–20% in a single day. Energy consumption, proof of work, uses massive amounts of electricity. Criminal activity, early adopters used Bitcoin for illegal purchases on dark web markets. And they're not wrong, but supporters push back with perspective. Volatility is decreasing as adoption increases. Mining is gradually shifting toward renewable energy sources. Illicit use is a tiny fraction of global transactions, and cash is still criminals' favorite tool. In short, Bitcoin isn't perfect, but neither is the current system. It just puts the flaws in a different place. The halving, Bitcoin's built-in drama. Every 4 years, roughly, Bitcoin goes through an event called the halving. The reward miners earn for adding new blocks gets cut in half. Why does this matter? Because it slows down the creation of new Bitcoins, making them increasingly scarce over time. Historically, every halving has kicked off a wave of excitement, followed by rising prices. It's like a scheduled plot twist in Bitcoin's story. Part economics, part psychology, part ritual. Investors watch it closely, the media hypes it, and the cycle continues. Bitcoin versus the rest of crypto. Since Bitcoin's birth, thousands of other cryptocurrencies have launched. Some aim to fix Bitcoin's limitations. Others focus on entirely different goals, like powering smart contracts or decentralized finance. Still, Bitcoin remains the king of the hill. It's the most recognized, the most widely held, and the most battle-tested. It's the first stop for most new investors, and often it's the one they never sell. Culture and symbolism. Bitcoin isn't just a technology, it's become a cultural icon. To some, it represents financial freedom. To others, it's a symbol of rebellion against central banks and corporate control. And sure, for some, it's just a speculative roller coaster with meme potential. There are Bitcoin podcasts, memes, documentaries, conferences, and communities. People get Bitcoin tattoos. They wear BTC hats like it's a sports team. It's more than code. It's identity. The long game. Whether you believe Bitcoin will replace the dollar or just coexist with it, one thing's clear: it's not going away. It's forced banks and governments to rethink digital money. It's created new industries, from mining to hardware wallets to institutional custody services, and it's sparked new global conversations about privacy, power, and value. Most importantly, it's shown that an open, leaderless, decentralized system can run for over a decade, with no CEO, no bailout, and no shutdown switch. That may be Bitcoin's most powerful message. Trust doesn't have to come from people. It can come from protocol, because in the end, Bitcoin isn't just digital gold. It's a living, evolving experiment, one that's challenging everything we thought we knew about money. And we're only in the early chapters. Chapter 6, Ethereum and the Coding of Money. How smart contracts turn ideas into action. By now, you know Bitcoin, the OG, the pioneer, the one that kicked open the door to a whole new kind of money. But here's the thing. As groundbreaking as Bitcoin was, it had a pretty narrow job description. Be a secure, decentralized store of value and payment system. Nothing more, nothing less. Ethereum looked at that and said, cool, but what if money could do more than just sit there and be money? A new kid with bigger dreams. In 2013, a 19-year-old programmer named Vitalik Buterin published a white paper that basically said, what if we took blockchain technology and made it programmable, not just to record who sent how much to whom, but to run entire applications without middlemen? Think of it like this. If Bitcoin is a calculator, solid, reliable, does one job well, Ethereum is a smartphone. It runs all kinds of apps you didn't even know you needed. Ethereum didn't want to replace banks. It wanted to replace infrastructure, the systems and gatekeepers that define how we do business, form agreements, and exchange value. It was ambitious. It still is. Smart contracts, the secret sauce. The magic trick that made Ethereum stand out is something called a smart contract. And before you picture a tiny lawyer living inside your computer, let's clear this up. A smart contract is just code that runs exactly as programmed. No human interference, no delays, no, oops, we lost the paperwork. It's logic written in digital stone. For example, if person A sends 1 ETH, automatically transfer the digital deed of a house to them. If 10 people each contribute $50, release the funds to start a group project. If a bid beats the previous one, transfer ownership of an NFT to the new highest bidder. Once a smart contract is deployed, it's live forever, immutable, public, and transparent. No bank can block it. No court can reverse it. No employee can forget to file the form. It's automation with trust baked in. The fuel, Ether, ETH. Ethereum's native currency, Ether, isn't just a Bitcoin clone with a new name. Ether isn't primarily about being a store of value. It's gasoline for a digital engine. Every time someone runs a smart contract, sends ETH, or uses an app on the network, they pay a gas fee priced in ETH. Think of it like renting space on a global supercomputer. The more complex your operation, the more it costs to process. This setup makes users think carefully before spamming the system, and it gives ETH real-world utility beyond speculation. The App Store without a company. Because Ethereum is programmable, developers around the world started building decentralized applications, or dApps, directly on top of it, and they built fast. Decentralized exchanges where people trade crypto directly, wallet to wallet, without a middleman. NFT marketplaces where artists sell digital creations without needing a gallery or record label. DeFi platforms offering loans, savings, insurance, and trading, all without traditional banks. Here's the kicker: no one owns these apps. There's no CEO, no server farm, no off switch. They run on code and community. Ethereum gave birth to a new kind of software, open, unstoppable, and governed by its users. The DAO experiment. One of Ethereum's earliest high-profile experiments was the DAO in 2016, a decentralized venture capital fund run entirely by smart contracts. People could send ETH to join the DAO and vote on how the money would be spent, all governed by code. It raised over $150 million, a record at the time. Then, it got hacked. Not because Ethereum itself was broken, but because the DAO's own code had a vulnerability. A hacker exploited it and drained millions. Cue chaos. The Ethereum community had to make a painful choice. Stick to code is law and let the hack stand, or roll back the blockchain to undo the damage? They chose the rollback, and in doing so, split the chain into two: Ethereum, ETH, and Ethereum Classic, ETC. It was a tough moment, but it taught the community a valuable lesson. Decentralization is hard, and smart contracts are only as smart as the people who write them. Proof of stake, the big energy diet. Ethereum originally used the same proof of work system as Bitcoin. Lots of computing power, lots of electricity. But in September 2022, Ethereum pulled off something many thought was impossible. It switched to proof of stake in an event known as the merge. Now, instead of miners, Ethereum has validators who stake their ETH as collateral to secure the network. If they cheat, they lose their stake. The result? Energy use dropped by more than 99% overnight. Ethereum became greener, leaner, and more future-ready. Proof of stake also opened the door for new features, better scalability, and broader participation. Ethereum's role in the NFT explosion. If you were online in 2021, you couldn't escape NFTs. pixel art punks, apes in sunglasses, music albums, tweets, you name it. And guess what powered most of it? Ethereum. That's because Ethereum's smart contracts made it easy to mint, sell, and verify ownership of unique digital assets. Sure, the hype got weird. Some people made fortunes selling JPEGs. Others lost it all chasing the next hot trend. But beneath the noise was a powerful idea. Ownership in the digital world, verified by the blockchain. It was cultural, not just financial, and Ethereum was the stage where it played out. The scaling problem. Ethereum is powerful, but it's also popular, and popularity creates problems. When the network gets busy, gas fees skyrocket. Sending a $10 token could cost $40 in fees, not ideal. To fix this, developers are working on Layer 2 solutions, side networks that process transactions off the main chain and bundle them together. Think of it like using a subway during rush hour. Only this subway skips stops and costs less. Projects like Arbitrum, Optimism, and ZK Sync aim to make Ethereum faster, cheaper, and ready for mainstream use. It's a work in progress, but progress is happening. Why Ethereum matters. Ethereum didn't just build a new coin, it built a new computing platform, one where money, identity, content, and code can all live together. It changed the question from what is crypto to what can crypto do. It also became the heart of Web3, a vision for a more user-owned internet. One where platforms aren't controlled by big tech, but by users and open protocols. Ethereum is where that vision is being tested, in real time, with real money and real stakes. The human side of the story. Part of what makes Ethereum feel different is that it still feels human. Vitalik Buterin, Ethereum's co-founder, is known for his awkward charm, unicorn shirts, and open writing style. He doesn't act like a billionaire. He acts like a curious hacker still trying to solve a puzzle. The Ethereum community reflects that energy. It's made up of developers, artists, economists, cypherpunks, and idealists, all building in the open, all arguing constantly, all pushing the boundaries. It may be messy, experimental, and intensely online, but crucially, it's alive, and that is where the magic truly lies. Ethereum isn't perfect. It's had bugs, forks, growing pains, and fierce competition from newer blockchains. But it's still where the action is, the sandbox where people come to play, fail, learn, and try again. The big picture. Ethereum proved that money is just the beginning. If Bitcoin said, you don't need banks, Ethereum said, you don't need permission. It gave us smart contracts, decentralized apps, digital art markets, self-governing communities, and programmable money. It turned the blockchain into a platform for ideas that now live forever on-chain, transparent, and unstoppable. And whatever comes next, one thing is clear. Ethereum didn't just ask what blockchain is, it asked what it could be, and we're still discovering the answer. Chapter 7, The Wild World of Altcoins. From stablecoins to meme coins, chaos, creativity, and everything in between. If Bitcoin is the stoic, gold standard, elder statesman of crypto, altcoins are the younger siblings who raided the fridge, started a garage band, and are now trying to invent their own genre of music. Altcoin just means alternative coin, basically any cryptocurrency that isn't Bitcoin, and there are a lot of them. Over 20,000 at last count, which is both impressive and slightly terrifying. Some are groundbreaking innovations, others are more like digital lottery tickets wrapped in memes and marketing hype. Let's take a walk through this unpredictable jungle. The early days of anything but Bitcoin. When Bitcoin proved that decentralized money could actually work, developers around the world got curious and a little ambitious. The first wave of altcoins focused on improving Bitcoin's mechanics. Some wanted faster transactions, others tried different mining algorithms or more privacy. Litecoin launched as the silver to Bitcoin's gold. Namecoin tried to decentralize internet domain names. Peercoin introduced early concepts of energy-saving proof of stake. And then there was Ripple, XRP, targeting not the individual user, but the banks themselves. Its goal? Speed up global transfers between financial institutions using a tokenized bridge. Even early on, altcoins weren't just clones, they were experiments in direction. Ethereum's ripple effect. Then came Ethereum, and everything changed. Ethereum proved that blockchains could do more than just move money. They could run entire applications on-chain. Suddenly, altcoins didn't just aim to tweak Bitcoin, they were launching entirely new economies. You had tokens for gaming worlds, where items could be owned and traded. Prediction markets, where users bet on future events. Supply chain networks, verifying goods from farm to shelf. Decentralized identity, allowing you to control your data. From niche platforms to billion-dollar ecosystems, Ethereum showed that coins could be tools, not just tokens. Stable coins, the calm in the storm. Crypto markets are known for their mood swings. Sometimes it feels like watching a roller coaster from the front seat. Stablecoins were invented as a kind of motion sickness remedy. These are tokens pegged to the value of a stable asset, usually the US dollar. USDT, Tether, USDC, and DAI. These coins don't aim to moon, they aim to stay boring. And in crypto, that's saying something. They're used for trading, earning interest in DeFi, transferring funds quickly, hedging during market crashes. But not all stablecoins are created equal. Some are backed by real dollar reserves. Others, like DAI, use crypto collateral. And some, like the infamous Terra USD, used algorithms to stay stable until they didn't. When Terra collapsed in 2022, billions were lost, a painful reminder that even stable isn't always safe. Utility tokens, tickets to the digital theme park. A utility token gives you access to a product or service, kind of like arcade tokens or theme park wristbands. BNB is used to get discounts on Binance trading fees. Chainlink, Link, powers a network of oracles feeding real-world data into smart contracts. Basic Attention Token, BAT, pays you for watching privacy-respecting ads in the Brave browser. These tokens usually gain value when the platform grows and lose relevance when the service fades away. It's all about actual use. The more people need the token, the more demand it has. Governance tokens, voting power in the new economy. Crypto isn't just about decentralizing money, it's about decentralizing control. Some projects issue governance tokens that give holders the power to vote on decisions. Should the protocol change its fees? Should a new feature be developed? Should a community fund be spent? Tokens like Uniswap, Uni, and Aave give users a stake in how things evolve. In theory, it's like shareholder democracy. In practice, a few large wallets often hold most of the power. Still, it's a step toward transparent, community-led development. Meme coins, the wild west of crypto culture. And then there are the meme coins. Dogecoin started as a joke in 2013. Literally, it had no serious roadmap, no killer app. Just a Shiba Inu meme, low fees, and a loyal fanbase. Years later, it exploded, thanks in part to Elon Musk tweets and a Reddit-fueled culture war with Wall Street. That opened the floodgates, Shiba Inu, Floki Inu, Pepe Coin, and countless others ending in Inu or Moon. Some meme coins try to evolve into serious platforms. Others just ride the hype until it dies. They're high risk, high meme, low fundamentals, but they've brought millions into crypto for the first time. Sometimes fun is the use case. Privacy coins, money without the spotlight. While most blockchains are transparent by design, some altcoins prioritize privacy. Monero, XMR, Zcash, ZEC, Secret Network. These use advanced cryptography to hide sender, receiver, and amount. It's like cash in a digital world. Fans say this is essential for freedom and privacy. Critics argue it can be misused, and governments aren't thrilled either. Privacy coins live in a legal gray area in many countries, but their existence raises a vital question. How private should digital money be? The ICO boom and bust. In 2017, the crypto space entered Wild West startup mode. Projects began raising money through initial coin offerings, ICOs, like IPOs, but unregulated and global. The pitch was often vague. Buy our token now. Trust us, it'll be huge. Billions flowed in, some projects delivered, many disappeared, a few were outright scams. Eventually, regulators stepped in, the frenzy faded, but the concept lived on, evolving into IDOs on decentralized exchanges, launchpads, and token pre-sales. Lesson learned, hype sells but execution is everything. Altcoin season, the crypto fever dream. Sometimes the market enters a phase where Bitcoin goes flat and altcoins explode. This is known as alt season, when traders chase 10x, 50x, even 100x returns in obscure tokens. It's fun, it's fast, and it's often followed by brutal crashes. Veterans say, in alt season, everyone's a genius, until the music stops. If you're in it for the adrenaline, it's thrilling. If you're in it for the tech, maybe keep a second portfolio. The double-edged sword of innovation. Altcoins are where blockchain innovation happens, but not all experiments work. For every Ethereum or Chainlink, there are hundreds of tokens that launch, pump, and vanish, run out of funding, get abandoned, or just never find a real use. Some projects are brilliant, others are solutions in search of a problem, but even failures teach the space how to evolve. Crypto is still early-stage tech, and altcoins are its testing ground. How to survive the altcoin jungle. If you're thinking about exploring the altcoin space, here are a few survival tips. Do your research. Who's behind the project? What's the roadmap? Is it solving a real problem? Understand the tokenomics. How is the token distributed? Are insiders holding most of it? Look for utility, not just hype. Does the token have a reason to exist? Be wary of promises. If it guarantees profits, it's probably a scam. Never invest more than you can lose. Seriously, it's like venture capital, except more chaotic. Approach altcoins like a scientist in a lab, curious, optimistic, but wearing safety goggles. Why altcoins matters. Altcoins are chaotic, inconsistent, and often ridiculous. But they're also where new ideas are born. They test what's possible. They stretch the limits of what blockchains can do. Many will fail, some will succeed, but all of them, even the weirdest ones, are helping shape the next generation of crypto. They're proof that blockchain isn't just one thing, it's a toolkit, and everyone's building something different with it. Even if 90% fade into digital dust, the 10% that stick might just build the future. Chapter 8. The Bright Side. Fast money, global reach, and freedom from the old guard. Let's be real. The crypto world gets a lot of criticism. Price crashes, hacks, rug pulls, scams, billionaires tweeting rocket emojis and making markets swing like a roller coaster in a hurricane. And yeah, all of that happens. But for all the chaos, there's also a side of crypto that's genuinely exciting. The part that makes people stick around even after the wildest dips. The side that isn't just about chasing Lambos or hype coins, but about actual possibility. This chapter is about that side, the bright side. Speed that makes banks look like snails. If you've ever tried to send money internationally through a traditional bank, you know the drill. Fill out a form, pay a fee, wait 2 to 5 business days, maybe get a weird phone call about international compliance, hope the money shows up eventually. In crypto, you can send Bitcoin, ETH, or a stablecoin to someone on the other side of the planet in minutes, sometimes seconds, depending on the blockchain. And it doesn't matter if it's Saturday at 2 a.m. The network doesn't care, it never sleeps. Sure, there might be a transaction fee, but compared to a $45 wire transfer or a multi-day remittance delay, crypto feels like teleportation. Borderless by design. One of crypto's most powerful features is that it doesn't care about borders. A Bitcoin address in Berlin works exactly like one in Nairobi, Buenos Aires, or Manila. You don't need a bank account. You don't need government approval. All you need is a smartphone and an internet connection. For the 1.4 billion people globally without access to traditional banking, that's not just convenience, it's financial inclusion. Crypto can offer savings, payments, lending, and income in places where the traditional economy barely reaches. No passport, no problem. The blockchain doesn't ask for ID. Financial control in your hands. In the traditional system, your money lives in a bank account the bank controls. They can freeze it, deny transactions, set limits, even close your account if they feel like it. And in many countries, that's not just theoretical, it happens. In crypto, if you hold the private keys, the money is yours. Full stop. No third-party approval, no gatekeepers. No, our system is experiencing delays. Of course, that power comes with responsibility. Lose your private keys and you lose access permanently. There's no forgot password button in crypto. But for many, the freedom is worth the risk. Opportunities for the underdog. Crypto is more than currency. It's an ecosystem of opportunity. Artists can sell NFTs directly to fans. Developers can build dApps and get paid in crypto. Creators can receive micro tips from supporters all over the world. Freelancers can get paid in stablecoins instead of waiting weeks for international bank wires. In some parts of the world, farmers are using blockchain tech to verify the origin of their crops and get better prices. Remote workers in the Philippines earn stablecoins to avoid remittance fees and get paid instantly. Crypto gives people the tools to build and participate, no matter where they start. Transparency you can actually verify. What's your bank doing with your money right now? Chances are you don't know. You're not supposed to. In crypto, especially on public blockchains like Ethereum or Bitcoin, every transaction is visible, forever. You can see how much was sent, when it was sent, and which address received it. You can even verify how many coins exist, whether a smart contract does what it promises, or where donations to a charity ended up. This kind of radical transparency isn't just good for trust, it makes abuse much harder. It doesn't replace regulation, but it can complement it or even outperform it in some cases. Programmable money, endless possibilities. Smart contracts turn crypto from just digital cash into a programmable financial system. Want to send a recurring donation that stops if a goal is met? Set up a rental payment that only goes through if a smart lock is activated? Create an insurance contract that pays out automatically if a weather event is confirmed? You can write all that into code. Once deployed, it runs without human interference. No middlemen, no approvals, no phone calls, just rules that execute themselves. That opens doors the traditional financial system can't even knock on. Microtransactions that actually work. In the traditional system, sending 0.03 is basically impossible. The fees are higher than the amount. With crypto, sending fractions of a cent is easy, especially on fast, low-fee networks. That changes everything for content creators, online tipping, pay-per-use services, and even machines paying other machines. Think about reading a paywalled article for 0.05. No subscription, just a one-time payment. With crypto, that's not a dream. It's just infrastructure waiting to be adopted. A hedge against inflation, sometimes. In countries where inflation is out of control, savings disappear overnight. Your paycheck buys less by the time you reach the store. Local currency becomes a hot potato no one wants to hold. Crypto, especially Bitcoin and stablecoins, can provide a lifeline. Even volatile crypto assets can be more stable than the collapsing currency next door. In Argentina, people use USDT to save value. In Turkey, stablecoins are a common hedge. In Venezuela, entire communities rely on crypto for daily purchases. Crypto won't fix inflation, but it gives people an exit, and that matters. Global collaboration without gatekeepers. Crypto doesn't just connect money, it connects builders. Developers in India, Brazil, the US, and Nigeria can all contribute to the same DeFi protocol without forming a company, signing a contract, or flying to a central HQ. Open source tools, global forums, and permissionless systems have created a kind of digital city, one where the best ideas can come from anywhere. If the internet flattened information access, crypto is flattening economic access. The movement factor. For many in the space, crypto is about more than making money. It's about decentralization. No more choke points controlled by corporations. It's about privacy, digital tools that don't surveil by default. It's about sovereignty, taking back control of your assets, your data, your identity. That's why so many people are building in crypto even when prices crash. They're not chasing trends, they're building a new system, a more open system, a more fair system, one that works for the 100%, not just the top 1%. Why the bright side still matters? Yes, crypto is messy. Yes, it has growing pains, but beneath the noise is something worth paying attention to. For every story of a rug pull, there's one about a refugee crossing borders with their savings stored in a mobile wallet. A creator finally earning what they're worth without middlemen. A developer in a remote town contributing to a billion-dollar open-source protocol. The bright side isn't theoretical, it's real, and it's already here. Crypto isn't just an investment class, it's an invitation to build, to participate, to own. And for millions of people, that invitation has already changed everything. Chapter 9, The Dark Side. Price crashes, cybercrime, and the shadows behind the hype. If the upside of crypto is speed, freedom, and non-stop innovation, the downside is the part of the theme park where the lights flicker and the rides feel a little too shaky. Blockchain is powerful, and crypto has real promise, but any technology that offers this much freedom also leaves room for abuse, greed, and plenty of chaos. This chapter is about the risks, traps, and hard lessons that many in crypto learn, sometimes the hard way. Volatility. The mood swings of the market. Crypto prices don't just move, they whip around. Bitcoin can drop from $50,000 to $42,000 in a day for no obvious reason other than everyone getting nervous at once. And altcoins are even more extreme. They can shoot up tenfold overnight and crash just as fast a couple of days later. For day traders, that volatility is the thrill. Fast swings, big upside, non-stop action. But if you're trying to use crypto for payments or long-term savings, it's a real issue. Getting paid in Bitcoin on Friday and waking up Monday to find your salary down 20% isn't exactly practical. Even stablecoins, meant to be predictable, can fail spectacularly if poorly designed, as we saw with the collapse of Terra USD. Volatility can be managed but never ignored. Scams. The digital gold rush brings digital snake oil. Crypto has become a playground for scammers, and the tactics range from painfully obvious to disturbingly clever. There's a reason even seasoned investors get caught off guard. Rug pulls happen when a team builds hype, takes the money, and disappears. Phishing scams use fake but believable sites to trick people into revealing their private keys. Pump and dump groups coordinate quick buys to spike a token, then dump on everyone else. And some wallets are outright fakes, built to drain your funds the moment you use them. And since blockchain transactions are irreversible, there's no undo button, no chargebacks, no friendly customer support rep. Once it's gone, it's gone. Hacks, not just in Hollywood. Blockchains like Bitcoin and Ethereum are extremely secure, but the things built on top of them, not always. Centralized exchanges, smart contracts, DeFi platforms, wallet software, all of these have been hacked at some point, sometimes to the tune of hundreds of millions of dollars. Sometimes the hack is due to a coding bug. Sometimes it's a case of bad key management or phishing. Other times, insiders are involved. There are even stories of projects faking their own hacks as a cover to steal user funds. And even if the hacker is caught, recovering the funds is rare. Crypto can be moved through dozens of wallets, tumbled through privacy mixers, swapped across chains, making it nearly impossible to follow the trail without serious forensic firepower. Regulation. The uncertainty cloud. Crypto exists in a legal gray zone in much of the world. Laws are constantly changing, and enforcement often lags behind innovation. That means projects, exchanges, and even investors operate in a constant state of uncertainty. One day your go-to exchange is running normally, the next it's suddenly banned where you live. A project you backed might later get labeled an unregistered security. New tax rules can pop up and change what you have to report. Governments are scrambling to catch up, but they're not aligned. Some welcome crypto, others are tightening the screws. The result? Whiplash and stress, especially for projects that are global by nature, but subject to dozens of conflicting rules. Energy use, a burning question. One of the loudest criticisms of crypto, especially Bitcoin, is its energy consumption. Proof of work. Mining requires enormous computational power, and that power draws electricity, a lot of it. Critics argue that mining is wasteful, contributing to climate change and soaking up energy that could be used more productively. Supporters argue that Bitcoin mining is increasingly powered by renewables and that it provides an incentive to use otherwise wasted energy sources. Whatever side you're on, the reality is this: the environmental impact of crypto is under scrutiny, and it's a narrative that isn't going away. Ethereum's move to proof of stake cut its energy usage by over 99%, and that set a new standard many expect others to follow. Privacy, or perhaps only something resembling it. Many people think crypto is anonymous. In truth, it's usually pseudonymous. Every transaction is public and permanently recorded on the blockchain. If someone can link your wallet address to your real identity, they can see everything: your trades, your balances, your entire transaction history. There are privacy-focused tools like Monero or Zcash, but they're far from mainstream. In some countries, even using them can trigger legal suspicion. Getting real privacy in crypto takes know-how, care, and a bit of nerve, because once someone starts digging, there's not much room to disappear. Crypto is still a headache for most people. Seed phrases, gas fees, wallet addresses that look like static, confirmations, bridges, staking, slippage, the list goes on. And the worst part is that mistakes aren't harmless. One wrong click and your money's gone. Send money to the wrong address, it's gone. Lose your seed phrase? That's the end of the story. Fall for a fake app or website, your portfolio disappears. The tools are improving, but they're nowhere near foolproof. And unlike a bank, there's no hotline to call. In crypto, you're your own support team. Market manipulation is a major problem in crypto. The space is young and lightly regulated, so it's easy to exploit. A single influencer can skyrocket a coin with one post. Reddit or Telegram groups can coordinate pumps. And whales can move prices whenever they feel like it, sparking fear or hype on demand. Some platforms even allow leverage trading with 100x bets, turning already risky assets into casino chips. It's thrilling, sure, but it's also dangerous. And more often than not, retail investors are the ones who lose when the music stops. Legal uncertainty is a real issue. Because crypto is global, a lot of projects base themselves in places with loose or murky rules. That helps them move fast, but it leaves users exposed. If an exchange vanishes or gets hacked and it's headquartered in some far-off jurisdiction, you're basically out of luck. Recovering funds through legal channels is rare. Even worse, some of these jurisdictions have been used deliberately to avoid accountability, a tactic that works until it doesn't. The mental strain is real. Crypto runs non-stop, so the market never gives you a break. Price alerts hit you in the middle of the night, news is constant, and the mix of FOMO, fear, greed, and regret can wear anyone down. Even seasoned investors admit it can be exhausting. Managing a portfolio in crypto is as much about discipline and emotional control as it is about strategy. Without that, it's easy to make impulsive decisions, buying at the top, selling at the bottom, chasing the next shiny thing until it's too late. The reality check. All of this isn't to say crypto is doomed, far from it. But it's important to go in with your eyes wide open. The dark side isn't a reason to turn away. It's a reason to be smarter, safer, and more skeptical of hype. Every technological revolution has its risks. The internet had scams, pop-ups, and viruses. Stock markets have crashes, fraud, and manipulation. Crypto is no different, just faster, more global, and a little more unforgiving. If you want to thrive in this space, you have to respect the risks as much as the rewards. Learn the lessons others have paid dearly for. Double-check before clicking. Question everything. Take your time. Because in crypto, the distance between opportunity and disaster can be just one transaction away. Chapter 10. When governments strike back. How regulations, taxes, and CBDCs are redrawing the crypto map. If the early story of crypto was all about decentralization, freedom, and wild innovation, the next chapter is a lot less flashy, but unavoidable. Once something grows big enough to move billions and bump up against traditional finance, governments step in. Lawmakers, regulators, and tax authorities are now paying attention, and they're not leaving anytime soon. At first, they didn't even notice. Then they got curious. Now, they're suiting up. The first reaction: confusion. When Bitcoin launched in 2009, governments barely noticed. It looked like a niche experiment with no backing and no big price moves, and regulators were busy dealing with the financial crisis. Crypto wasn't even on their radar yet. A few years later, Bitcoin passes $1,000, Ethereum launches, altcoins multiply, and scams spread. Crypto turns into a fast-growing market, and regulators have no idea how to classify it: currency, security, commodity, or something else. Different countries and even different agencies within the same country gave different answers. Confusion was everywhere. Governments responded in all kinds of ways. Switzerland and Portugal embraced crypto early, creating clear rules that attracted startups and talent. They positioned themselves as crypto-friendly hubs with low taxes and stable regulation. Singapore followed a similar path: stricter oversight on exchanges, but strong support for innovation. Meanwhile, China went the other way. The government outlawed mining, shut down exchanges, and banned trading altogether. Officially, the reasons were financial stability, capital controls, and environmental concerns. But it was also about keeping tight control over what counts as money and who gets to issue it. The United States took a more complicated route. Crypto is legal, but heavily scrutinized. The SEC, IRS, CFTC, and FinCEN all have opinions, and often those opinions overlap or contradict. It's legal to buy crypto, but launching a token could get you sued. You can trade it, but don't forget to report every single move on your taxes. Other countries, like India, Nigeria, and Brazil, have wavered, first threatening bans, then pulling back, then introducing partial restrictions. The result is a patchwork global map where crypto is embraced in one country and outlawed in the next. KYC and AML, no more anonymity at the door. As crypto gained adoption, regulators quickly moved to require KYC, know your customer, and AML, anti-money laundering rules, especially for centralized exchanges. If you want to buy, sell, or cash out crypto through a major platform, you'll likely need to verify your identity with a government ID, proof of address, and maybe even a selfie with today's date. Supporters argue this protects against terrorism financing, fraud, and money laundering. Critics say it undermines privacy and contradicts the original idea of decentralized, permissionless finance. Either way, it's the new standard. Anonymous crypto trading, once the norm, is now the exception. The taxman. Finally arrives, most governments want control and tax revenue, and crypto complicates both. Their solution: treat it like property. That means you owe capital gains whenever you sell, trade, or even spend it. In some countries, even swapping one token for another counts as taxable. That turns everything into a paperwork mess. Every trade or swap can be a taxable event, so you have to track timing, cost basis, and profits. Active traders can end up with hundreds or thousands of entries a year. There are even companies built solely to help people sort out their crypto taxes, which says a lot about how complicated it's gotten. Some countries, like Germany, are more lenient. If you hold crypto for over a year, you may owe nothing. Others, like the US, are aggressive. Forget to report, you could face fines, audits, or worse. The securities question. One of the thorniest issues is whether certain cryptocurrencies should be regulated as securities. If a token is classified as a security, the people who issue or promote it must follow strict laws designed for public companies, including registration, disclosure, and compliance requirements. In the US, the SEC has gone after multiple crypto projects, claiming their tokens are unregistered securities. Ripple, XRP, has been tied up in a major court fight for years. How these cases end will shape what's considered legal and illegal in crypto for a long time. To developers, this feels like trying to fit a spaceship into 1930s airplane regulations. The rules were built for Wall Street, not Web3, but until those laws are updated, this legal gray area will continue to chill innovation or drive it offshore. CBDCs, the governments strike back digitally. At the same time, governments are building their own blockchain-inspired systems, central bank digital currencies. They're basically digital versions of national money, fully centralized, government-controlled, and running on digital rails that may or may not use blockchain at all. Dozens of countries are piloting or planning CBDCs, including China, the EU, and the US. The idea is to modernize money, faster transactions, better tracking, programmable features, reduced reliance on cash. Critics warn that CBDCs could give governments unprecedented control over spending. They could freeze accounts, monitor purchases in real time, or enforce policy through code. Supporters say CBDCs could boost financial inclusion and reduce corruption. Like everything in crypto, it depends on how it's used and who's in control. Bans, crackdowns, and capital flight. Some governments have gone all in on crackdowns. China's total ban on trading and mining pushed miners out overnight and shifted global hash power. India has repeatedly floated full bans. Turkey outlawed crypto payments. Other countries have taken smaller swings, restricting mining, ads, or anonymous wallets. The result? Activity moves. People use VPNs, projects relocate, exchanges set up subsidiaries in more permissive jurisdictions. You can ban the surface, but the core tech is hard to kill. The global tug of war. Here's the challenge. Crypto is global, but regulations are local. What's legal in Dubai might be illegal in Denmark. A DeFi app can be coded in Kenya, launched in Estonia, used in Argentina, and banned in South Korea, all in the same week. This mismatch leads to regulatory arbitrage, where businesses set up shop in the friendliest countries while still serving global customers. Some governments are now trying to coordinate internationally through groups like the FATF or the G20. But so far, it's a regulatory arms race, not a coordinated campaign. Innovation. Under pressure, crypto developers don't hate rules. Most just want clarity. They need to know what's allowed, what's not, what counts as a security, what licenses do we need. Unclear or overly aggressive regulation pushes innovation elsewhere. A developer who could build a billion-dollar protocol might just move to Lisbon or Dubai instead of jumping through 100 bureaucratic hoops in New York or Berlin. But clear, fair rules, those can attract capital, talent, and stability. Some jurisdictions are catching on. They're offering regulatory sandboxes, controlled environments where startups can test new ideas without being crushed by compliance. Others are rolling out special crypto frameworks tailored to the unique aspects of blockchain. Why governments can't ignore it anymore? Crypto isn't going away. Billions in daily trading volume, hundreds of millions of users, billion-dollar companies, and yes, laser-eyed politicians. It's all part of the modern economy now. Whether it's Bitcoin, Ethereum, stablecoins, or CBDCs, digital assets are no longer fringe. Governments know that. And while some want to shut it down, most are realizing they can't. The better move is to shape it, to build laws that protect people without killing innovation, to regulate without smothering, to balance safety with freedom. The story of crypto and government isn't a war, it's a negotiation. And the outcome will determine what the future of money looks like, not just for tech geeks or hedge funds, but for everyone. Chapter 11. The next big waves, Layer 2, Web3, Metaverse money, and AI meets crypto. Crypto's already had its big explosions, Bitcoin, Ethereum, the DeFi rush, the wild NFT cycle. But that wasn't the peak. Those waves were just the start of a much bigger swell. Builders are still at it, money's still coming in, communities are still trying new things, and a fresh wave of ideas is gearing up to push the space forward all over again. A big part of crypto's next chapter is scaling, clearing the bottlenecks that held it back. That's where Layer 2s step in. If Ethereum is a crowded street, Layer 2s are the fast lanes above it. Optimism, Arbitrum, ZK Sync, and others let you transact quickly and cheaply while still leaning on Ethereum's security. They batch transactions off-chain and settle them on-chain, giving you speed without sacrifices. For developers, that's a turning point. Suddenly, on-chain games or micro-lending apps are actually practical. Layer 2s aren't side tech anymore. They're the foundation of what's coming next. As we move up the stack, the Web3 idea comes into focus. It's not just a new version of the internet, but a shift in who actually owns and benefits from it. Today, companies control your data, your identity, and the value you create. Web3 turns that around. Your identity sits in your wallet, your data belongs to you, and the platforms you help build can reward you with real ownership, not just likes. Picture a decentralized Spotify where artists and listeners both earn from every stream, or a YouTube-style platform where the community votes on moderation instead of a single company. That's the promise. It's still early, still rough, and definitely surrounded by hype, but the direction is clear. But it's also one of the most genuinely exciting movements in tech. And then there's the metaverse. The metaverse has been overhyped, but the core idea still holds: a persistent digital world where identity and ownership are real. Picture virtual concerts, digital land, and avatars you can use anywhere, all powered by crypto. You own your identity, not a platform. NFTs prove your items are unique. Tokens act as currency, and anything you buy is a real asset you can trade or carry across worlds. It's not an escape from reality, it's a new layer on top of it. AI and crypto might look like an odd mix, but they fit together surprisingly well. Blockchain can make AI more transparent by proving where training data comes from and giving decentralized AI projects a way to run without big tech owning everything. AI, in turn, can boost crypto by improving smart contracts, spotting scams, powering trading tools, and helping DAOs run more smoothly. One of crypto's long-standing problems, blockchains not talking to each other, is finally getting real solutions. Right now, chains like Ethereum, Solana, and Avalanche are basically separate worlds. Moving assets between them usually means using bridges that are clunky, risky, and slow. Interoperability projects are trying to fix that. Polkadot and Cosmos aim to connect these isolated networks into a shared ecosystem. Chainlink's CCIP is pushing towards smart contracts that can interact across chains as easily as websites link together. Once this becomes smooth and reliable, people will stop thinking in terms of individual blockchains and start seeing the whole thing as one connected crypto network. Identity is getting a serious overhaul. Right now, your online identity is scattered across accounts you don't truly control, and losing an email or phone number can wipe out access to everything. With decentralized identity, you use a single wallet-based identity that you fully own. You choose what to reveal and when. You could prove you're over 18 and living in the US without sharing your birthday or address. That level of control can reshape how we handle logins, credit checks, hiring, healthcare, and even voting. In finance, DeFi is moving into a more mature stage. The first wave focused on yield farming and flashy returns, but most of that wasn't built to last. Now the focus is shifting towards safer, more polished products, lending platforms with built-in insurance, decentralized exchanges that feel as simple as the big centralized ones. The aim is real value and real usability for everyday users. Another big shift is tokenization, putting real-world assets on-chain. Property, art, stocks, bonds, collectibles, even wine can become tokens you can trade or own in fractions. It makes expensive assets far more accessible. You might never buy a Manhattan building, but you could own a small share of one. Institutions get better liquidity and efficiency, and individuals get access to opportunities that were once closed off. All this progress also brings a push for sustainability. After years of criticism over energy use, new chains are aiming to be carbon neutral from day one. Ethereum's move to proof of stake slashed its energy footprint by more than 99%. Other projects are going even further by using blockchain tech to fund renewable energy, verify carbon credits, and make environmental impact transparent and easy to audit. The cultural side of crypto is becoming just as important as the tech. People aren't joining only for profits anymore, but for the feeling of being part of something. Meme coins, NFT collectives, activist DAOs, citizen-run media. These aren't fringe experiments anymore. They show how crypto is becoming a way for people to express identity, build community, and organize around shared goals. And down the line, the most impactful crypto projects might not be financial at all, but social platforms, creative hubs, or grassroots groups that use tokens to coordinate and govern themselves. These waves won't all arrive at once. Some will crash, some will fizzle, but some will reshape the entire landscape, just like Bitcoin and Ethereum did before them. If there's one constant in crypto, it's this: the next big thing is always being built, and it's probably already here. You just haven't heard about it yet. Chapter 12, Your Look Ahead. What everyone should know about the opportunities, risks, and realities. If you've made it this far in our crypto journey, congratulations. You've essentially done a crash course in the future of money. We've gone from goats and gold coins to Bitcoin and blockchains, explored the bright spots, navigated the dark alleys, and peeked into what's coming next. Now it's time to step back and look at the bigger picture, where crypto stands today, where it might go, and how you can think about it without getting lost in the noise. The reality check. Let's be clear, crypto is not a magic money machine. It's not a guaranteed ticket to a Lambo, a private island, or early retirement, although yes, there are people who've done very well. What crypto is a brand new set of tools. And like any tools, they can be used brilliantly, used badly, or not used at all. This space is full of contradictions. It's global, but still local laws matter. It's decentralized, yet many people still store coins on centralized exchanges. It's transparent, but also a playground for anonymous players. That's part of what makes it fascinating. It's a living, evolving experiment. The long game versus the hype cycle. Crypto has its hype cycles, times when everyone and their dog, literally, in the case of Dogecoin, is piling in. Prices skyrocket, headlines scream new paradigm, and suddenly your uncle who hasn't touched a computer since 1998 is asking how to buy Ethereum. Then the crash comes, prices tumble, the headlines flip to crypto is dead. Again, it's been declared dead over 400 times by now, for the record. The people who survive these cycles, they focus on the long game. They learn during the quiet times. They don't FOMO into random coins just because they're trending, and they think about the technology's potential rather than just the price charts. Adoption is a slow burn until it's not. Think about the early internet in the 90s. At first it was clunky. Websites took forever to load. Most people didn't get it. Then suddenly email became normal. Online shopping took off, and you couldn't imagine life without it. Crypto feels a lot like that. It's still early. There are technical barriers, bad actors, and misunderstandings. But the pieces are being built. Payment systems, user-friendly wallets, faster networks, clear regulations in some places. And one day, much of it might just blend into the background, the way we don't think twice about using a credit card online now. What to watch for? If you want to keep an eye on crypto without drowning in endless information, focus on these three things. Real-world use cases. Is a project solving a real problem, or is it just a token looking for a reason to exist? User adoption. Are more people actually using the tech, or is it just traders passing coins back and forth? Regulatory clarity. Like it or not, government rules shape the industry. Watch for big legal changes in major markets. Your role in this story. Here's the empowering part. You don't have to be a coder, miner, or day trader to be part of this. You can learn the basics of how wallets and transactions work. Experiment with small amounts you can afford to lose. Support projects that align with your values, whether that's privacy, sustainability, or financial inclusion. And maybe most importantly, share what you learn. Every person who understands crypto a little better makes the whole ecosystem stronger. The mindset that works best. Approach crypto like you'd approach any high-tech frontier. Be curious, but cautious. Be optimistic, but realistic. Expect change and be ready to adapt. It's not about timing the market perfectly or chasing every new trend. It's about understanding the landscape well enough that you can navigate it without falling into every trap along the way. Why it's worth paying attention. Even if you never buy a single Satoshi, crypto is influencing the future of finance, tech, and even culture. Banks are testing blockchain settlement systems. Artists are selling directly to fans through NFTs. Countries are exploring digital versions of their currencies. Ignoring it completely is like ignoring the internet in 1995. You might not be ready to dive in head first, but knowing the basics could help you spot opportunities or at least avoid getting blindsided. The human factor, where technology ends and humanity begins. At the end of the day, crypto isn't just about algorithms, tokens, and protocols, it's about people. The developers building decentralized apps because they believe in freedom. The entrepreneurs trying to bring banking to unbanked communities. The everyday users sending money to family without paying 10% in fees. That's the heart of it. The tech is just the tool. The people are the story. So whether you end up holding Bitcoin for the next decade, experimenting with DeFi, collecting NFTs, or just watching from the sidelines, remember, you're living through one of the most interesting shifts in how humans think about money since the invention of paper currency, and that's worth paying attention to. If you've enjoyed this deep dive into the future of money, cryptocurrencies explained, then you're exactly the kind of person we're building Coin for. Hit that subscribe button, because this is just the start. We've got a ton of content coming your way, from simple coin-explained breakdowns to exchange reviews, to up-to-the-minute crypto news, and even the occasional hot take on where the market's heading. Stay curious, stay informed, and we'll see you in the next block.